The market is seemingly taking its mask off, with the S&P 500 crossing over 3,000 and the 200-day moving average for the first time since March. But the question remains, is it taking its mask off just a little too soon? In this week's video, our team's going to go over the divergence between the NASDAQ and the rest of the New York Stock Exchange, the returns from last week and some key news events, and also what to watch for in the weeks ahead.
Mike Tedeschi, Wealth Management Advisor with this week's chart breakdowns. We have two charts for you this week. We're going to take a look first at the NASDAQ 100 index. That's what's up on the screen. We closed last year at this zone, and we subsequently have actually risen almost 10% year to date, and we're actually only about 1.5% away here from all-time high in that 97.40 zone. The NASDAQ 100 has been extremely strong for the entire year. And to show you the difference between this and the overall market, we now take a look at the New York Composite Index, which is made up of all the stocks listed on the New York Stock Exchange. Not only are we nowhere near all-time highs, in fact, we are at this point about 22% away from those highs. We are actually not even back to the middle of last year's lows back in June, this 12,250 zone. We're way below the gap from earlier this year, and we have multiple major resistance zones sitting above us. One at 1175, another at 12,250, another up here at 13,250, and then that all-time high back up at 14,200. So there are a lot of levels of resistance above us. This very clearly shows us that the leaders are really leading this market, and the majority of the components in the indexes are still way off of their highs, and most of them are still way down for the year. In fact, the New York Composite Index year to date is down about 17%. We're going to continue to pay attention to the divergence between the top tier companies and the overall stock market itself to see if this can catch up to the NASDAQ or if the NASDAQ ultimately will catch up to this. See you guys next week.
It was a strong week out of the U.S. markets last week as the S&P 500, the Dow Jones, and the NASDAQ were all up over 3%. Now the Russell 2000 was up over 7%. And as Mike talked about in his part of the video, there's a big divergence between the Russell 2000, which is lagging, down still about 18% for the year, and the NASDAQ and the technology sector, which is up almost 4% year to date. Now, I wanted to note also that the S&P 500 is now up over 27% since March 23rd. And that's the strongest bear market rally that we've seen out of the US markets in the past 75 years. The biggest negative news story last week was a continued rise in unemployment numbers. Now, another almost 2.4 million people claimed unemployment last week, bringing that total to over 38 million so far. And that's almost 15% of the workforce, which is the worst that we've seen on record. Now, unfortunately, that expectation is to get to above 20% in the next few months, so that's something that we're definitely going to want to keep an eye on. The foreign markets were up over 3% last week as well. Now they're down just under 18% for the year, and emerging markets were positive, but they were only up about 1% last week. And that's due to a sell-off out of the emerging markets, especially out of the Chinese companies, towards the end of last week. And that was due to President Trump threatening to delist some of the Chinese companies from the US exchanges.
Last week, China took a direct shot at President Trump's plans to try to get US companies to move their manufacturing from China back to the US by devaluing their currency against the dollar to levels that we haven't seen since February of 2008. So what this means is US companies that have manufacturing in China now can produce the same amount of goods at a much less cost, which makes it very hard for companies to leave China to move their manufacturing back to the US. And President Trump really has three different things that he can do to help combat this. One, he can petition the IMF to try to go after China for currency manipulation. Two, he can slap additional tariffs on products produced in China. Or three, and this seems like the most likely scenario, is that he can actually give large tax incentives for companies to move their manufacturing out of China back to the US. And with all of the stimulus bills and additional infrastructure bills that are being discussed right now, we could see some additional tax incentives for those companies. The second story that we wanted to look at is the historic rise that we've seen in the commercial and industrial loan space. We're sitting right around $3 trillion in loans. That's a $1 trillion spike since February. Now, normally during economic recessions, we actually see loans go down as credit quality for companies actually deteriorates. But we can attribute all of these gains to the PPP loan program and also other incentives that the federal government has put forth to try to help businesses during this time. Now, it's pretty clear that the Fed has decided that they're going to spend their way out of this recession. And normally we would be talking about cutting interest rates at this time, but the Fed has already said they are not going to have negative interest rates here in the US. Now, one thing that we are starting to see because of all of the money that's being pumped into the system is increase in inflation for goods and services such as food, cars, homes, etc. Now, food prices rose 3.5% in April. Now, that's kind of understandable because everybody's spending a little more right now, and also there's a less of a supply of food. Now, car and home prices, that's a little harder to explain, as we're seeing record low numbers of car sales, but car prices continue to go up. And we're starting to see home prices tick up during a recession, which is something that we've never seen before. It really makes you wonder, is inflation directly tied to the record run that we've seen from the markets over the past couple months? Thanks for watching, and if you find this content valuable, make sure you subscribe to our channel.